Today, the Federal Reserve announced it would be tapering its monthly purchases of U.S. Treasury bonds and mortgage-backed securities down by $15 billion from its current level of $120 billion. This move is heralded by some as a response to rising levels of inflation, but in reality the Fed is in a box of its own making that it cannot escape from. For over a decade, the Federal Reserve has intervened in the markets, artificially suppressing interest rates by buying Treasury bonds, mortgage bonds, even junk bonds and stock equity positions. The Fed pointed to companies that would likely go under, and those who would lose their jobs. The Federal Reserve wanted to avoid an economic recession or depression, and justified printing the freshly made currency needed along such lines. However, recessions have long-term positive effects that if put off too long have negative consequences for the economy as a whole. In a recession, companies that suffer under poor management go out of business, but the elements that make up those companies, the employees, the buildings, machinery, and so on, do not simply vanish when a company goes out of business. Instead, the resources of the poorly managed companies become available to the economy as a whole. Instead of dragging along outdated, dying business models, or propping up overpaid management and employees, a recession forces businesses to do more with less, become more productive, and find new ways of doing business that they have not been incentivized to do since businesses simply keep getting bailed out by the Fed. This eventually leads to zombie companies. These are companies that don't have enough free cash flow to even pay the interest payments on the debts they own. They have to take out even more loans just to pay the interest on their debts. Such companies have no business being around, but with low interest rates and backing from the Fed, these companies continue to limp along, wasting resources that could be more productively deployed elsewhere in the economy. In addition, the Fed has been enabling the government to rack up dangerous levels of debt. U.S. government debt now totals nearly $29 trillion, while all tax revenue brought in annually equals little more than $4 trillion. The government can only afford its massive debt because the Fed finances it at an artificially low interest rate. Essentially, an interest rate of 14% would lead to a situation where every cent of U.S. tax dollars would only go to paying the interest on the debt. The box the government and Fed are in is actually much smaller than this calculation would suggest, however. Most federal tax dollars already go to mandatory programs like Social Security and Medicare. The amount of tax income available to pay interest on the debt is limited by these mandatory programs, so the amount of the interest rate necessary to consume all discretionary funds is actually much lower than 14%. If we allow for Social Security, Medicare, and defense spending, about $1 trillion in tax revenue remains before considering the interest owed on the debt, or any other government spending programs. This means if the rate asked for on government debt increases roughly 2.5 times or to about 3.5%, all tax dollars in the United States will be going only to Social Security, Medicare, defense, and interest on the debt. This also assumes that these programs do not increase in cost, which with the aging population increasing demands on Social Security and Medicare, this seems to be unlikely. This also assumes no increased spending on infrastructure, or expanded social programs. As a result, the Fed must keep interest rates low to keep the U.S. government from being crushed by interest payments on the debt. However, the Fed cannot keep interest rates low forever, due to the other side of the box that is closing in on them. The Fed has begun tapering their debt purchases because of record high inflation in the economy. 2021 has seen inflation shoot to well over 5% annually. This is even with government accounting measures for inflation that generally undercounts inflation as it is experienced by the average person. If the Fed cannot raise interest rates above the rate of inflation so that bonds offer a real return to investors, long-term people will lose faith in the value of the US dollar. The market will start anticipating a future where the value of dollars will continue to decline, and as a result the cost of goods and services will increase. People will pull forward as much of their future purchases as possible, assuming prices will be lower than if they were to wait to make those purchases later. The option available to the Fed to prevent such a scenario is to raise interest rates to encourage savings, increase investment in productivity, and reduce consumption. With inflation running at over 5%, and an effective interest rate of 3.5% that would destroy the federal budget, the Fed has no real options. It cannot allow an interest rate that will encourage savings with a return above inflation, because such an interest rate would also effectively bankrupt the government. If the Fed keeps enabling the government to spend, as it likely will, by buying bonds and keep interest rates low, increased inflation will be the outcome. The Federal Reserve is trapped between a deflationary depression and government default on one side, and runaway inflation that destroys the value of the US dollar and the legitimacy of the world's reserve currency on the other. There is no way out of this box for the Fed, just pain whichever way it turns. The Fed managed to tame inflation in the early 80s by raising interest rates to 20%. The current government cannot afford interest rates at 3.5%. Keep these numbers in mind as you make your own plans.